Hello, this is Group 13 and today we're presenting our Huawei IPO proposal. Quick summary of Huawei is that it is a leading global provider of information and communication technology infrastructure and smart devices. As you can see from figure 1, Huawei's market share for smartphones in China had a market share of 19% in 2021, which declined to 11% in 2022. This is due to various reasons such as the US ban and chip shortage. However, we believe that in the near future its market share will grow. From figure 2, we can see the financial ratios of some of the main competitors of Huawei, and that Apple is currently the biggest player in the market with both the largest market share and market capital of $2.29 trillion US. The above image represents a DCF model of Huawei based on historic data sourced from Huawei's annual statement and a set of assumptions taken to extrapolate data of Huawei's future performance and derive a value of Huawei today. These assumptions are related to certain variables such as earnings and profitability. It is important to mention that although Huawei had a significant decline in revenue during 2021, most likely due to the US ban, their operating profits actually increased, and so we believe that moving forward, their performance will grow based on their past performance over the years. According to Modigliani-Miller Proposal 2, the higher the level of debt, the higher the value of a company. However, this is not the case in reality, as their proposition assumes a perfect world which ignores the cost element of debt, and so the optimal capital structure is used to determine the level of debt at which the benefits associated with tax shield no longer outweigh the cost of debt. As a result, Huawei's debt level is closer to 55%, and so it retains its ability to restructure its level of debt in the future through borrowing or share buybacks without significant risk of financial distress. To calculate the terminal value, the weighted average cost of capital was used to derive at a discount rate that considers both cost of debt and equity, which then allowed us to determine the free cash flow and enterprise value of Huawei. Finally, from the model, we were able to arrive at a pre-IPO share value of $9.84. Figure 3 above shows the IPO value over varying levels of equity. With new equity of 65%, we get 38,793.7 million IPO value. Raising this amount of equity makes the post-IPO equity value go to 97,460.94 million US. To determine the price per share, in figure 4 we have shown how varying discounts affects the price to issue, and considering our post-IPO equity value with an issuing price of $7.88 US, our post-IPO value per share is $8.66. The reason for the consideration of discount is due to underpricing. This is because the level of underpricing depends heavily on the company's growth prospect and the comparison of other IPO over the same period. Underpricing is transient. As investors demand, it will drive prices up to their market value. We also consider the winner's curse, which is the tendency for a winning bid in an auction to exceed the intrinsic value or true worth of an item. The gap in auction versus intrinsic value can typically be attributed to incomplete information, emotions, or a variety of other subjective factors that may influence bidders. If there is a 5 to 20% rise in share price in 2 weeks, we consider the IPO to be successful. The risk-free rate used in this case is the 10-year Treasury rate, which is 3.68%. Additionally, the market risk premium is 5% and the beta of Huawei to the market is 2.45, indicating that Huawei will move by 2.45% for every 1% change in the market return. Based on the CAPM model, the expected return on equity is estimated at 15.9%. APT takes into account several factors while determining the asset price. If Huawei's assets are momentarily mispriced, according to the APT model, arbitrage opportunity will cause the price to return to its fair value. We can use the inflation rate, GDP growth, market indices, and other macroeconomic factors as independent variables in this case. To summarize, our suggestion is to raise 38,395.7 million equity, which is equivalent to 65% equity. To do so, we suggest an offer price of $7.88 per share, which represents a 20% discount. However, the price may range from $7.88 to $8.86 depending on the level of discount used. Therefore, in order to raise the required equity, Huawei needs to sell 4,875 million shares, equivalent to 65% of equity shares. In terms of capital structure, Huawei is 35% debt and 65% equity, which is equal to 0.54 debt to equity ratio, which is relatively higher than some competitors but not higher than the average. Finally, based on the CAPM model, the return on equity is expected to be 15.9%.